All right. Today is Tuesday, November 22nd. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. But before we start, are you watching this World Cup or what? The Argentina-Saudi game was the best so far. And of course, in the aftermath, the Argentinian tulip crashed by more than 20%. That's the future, brah, isn't it? Someday cryptos will replace all of these fiat currencies. Okay, you mean financial assets that crash based on the outcome of a soccer game? But anyways, the market continues to march higher under a low volume, shortened trading Thanksgiving week, even though we got bad news this morning out of China of the resumption of lockdowns. Now remember, the Fed is a very confused organization. They want their cake and they want to eat it too. On one hand, they don't want the market to rally too high too fast because that loosens financial conditions and boosts inflation higher again. On the other hand, they don't want the market to become too pessimistic and shift into a recession mode because they're not through with the tightening campaign yet, and tightening under a recession-themed market could amplify the damage, not only to financial markets but also to the economy. Unfortunately for the Fed, they have to make a choice, either more inflation or a full-blown recession. And I will show you, based on the information today, that they have no other choice but to produce a full-blown recession to bring back demand to meet the anemic supply, especially in the energy market, which is the main subject of tonight. So without further ado, here it is, in focus tonight. Peak inflation, you say? Well, hold your horses. Because remember the deal that Joey B brokered with the railroad unions? Historic deal, before the midterms, of course. Now the deal has fallen apart and the strike is back on the table again, which means that everything that gets transported via railroad will cost us more. Not to mention the fact that we're going to see delays, which will also cost us more. In other words, more and more inflation to come. But if you thought that's bad, here's more. You see, all of these talking heads in the business news media, when they come out and say, oh, the CPI is peaking, the Fed is overreacting, they have to take it easy, the CPI is lagging. Look at the futures. Look at oil futures. They're down big. But the futures are just one piece of information we pay attention to. There is a lot more. For example, look at oil shipping costs. To the moon, baby. Surging higher and higher and higher. Any of the talking heads on TV talking about this? Of course not. Is this inflationary or is this disinflation? I think the answer is clear. But of course, the worst shortage of them all is this shortage of diesel. And it's not just happening in the United States. It is happening globally. But it's getting a lot worse here in this country, which means that everything that gets transported via truck, which uses diesel, that's going to cost you more because they have to pass the extra cost all the way down to the end consumer. That's inflationary. That's not peak inflation. The headline reads, Diesel shortage update as the U.S. supply will barely make it through winter. The inventories of diesel are at the lowest level since 2008, and this is a worldwide problem, folks. Listen to this. Within the next few months, almost every region on the planet will face the danger of a diesel shortage at a time when supply crunches in nearly all the world's energy markets have worsened inflation and stifled growth. In other words, stagflation. The toll could be enormous, feeding through into everything from the price of Thanksgiving turkey to consumer bills for heating homes this winter. In the U.S. alone, the surging diesel cost will mean $100 billion hit to the economy. That's what, one Ukrainian aid package? Anyways, in the U.S., stockpiles of diesel and heating oil are at their lowest point ever for this time of the year, in data going back 4 decades. Wow. Northwest Europe is also facing a low buffer. Inventories are forecast to hit a low this month and then tumble even more by March, shortly after the sanctions come into play that will cut the region off from Russian seaborne supplies. In other words, a self-inflicted wound. And if you thought it's bad in richer countries such as the US and Europe, think about poorer countries. Think about what you think about.
Think about what you'd think about.
Global export markets have gotten so tight that poorer countries like Pakistan are getting shut out, with supplies failing to book enough cargoes to meet the nation's domestic needs. It is certainly the biggest diesel crisis that I've ever seen, said Dario Scaffardi, the former chief executive officer of Italian oil refiner, who spent almost 40 years in the industry. Diesel in the spot market of New York Harbor, a key benchmark, is up roughly 50% this year. The price reached $4.90 a gallon gallon in early November, about double year-ago levels. Look at this. U.S. East Coast receipts of European diesel, they're anemic. They went down by a lot. There's nothing coming in. The majority of this crisis is happening in the East Coast of the United States, specifically in New England, which we're going to talk about in a minute. But if we're not getting supplies of diesel from Europe in the East Coast, then what happens? The inventories of diesel and heating oil in the East Coast hit a record low. Look at the trend here. We are way below average, meaning we have a severe shortage of supply. The only remedy to this is you got to bring demand down. You can't really magically create more diesel. You can't magically build refineries all of a sudden. That's not going to happen. So to prevent inflation from going higher at this point, the Fed must crash the economy in a severe recession for the demand to meet the anemic supply, as you can see from this chart right here. And what is the reason behind all of this? Why do we have a shortage in diesel? Of course, the media and the talking heads, they want you to believe that the reason for this inflation is the thing, the virus. The virus killed all of these supplies. The virus killed diesel because diesel forgot to take the jab. That's what happened. That's what they want you to believe. And if you think that that's too silly, they shift to, oh, it's Putin. Putin is responsible for all of this. And if you don't believe the Putin thing, they tell you, oh, it's a global supply problem. It's happening everywhere. It's not just here. But let's look at the real reasons behind this. What is causing the shortage? ? There are major constraints globally on refining capacity. Supplies of crude oil are already fairly tight, but the bottleneck is much more acute when it comes to turning that raw commodity into fuels, like diesel and gasoline. That is partially a function of the pandemic. Here we go. But listen to this. After lockdowns destroyed demand and forced refiners to close some of their last profitable plants. So once again, a self-inflicted wound. But here it is, the real reason. But the looming transition away from fossil fuels has also dented investment in the sector. In other words, the green energy lunacy, which in this program, we support green energy, but we support a gradual transition into green energy, not this lunacy of let's shut down everything. Meanwhile, we don't have the solar panels. We don't have the mines to produce the lithium, the cobalt, the nickel. We got nothing. But all of a sudden, we have to shut down oil entirely. We have to shut down the energy sector entirely and divest away from it and shut down and attack banks who fund the industry and attack energy companies as this evil. Meanwhile, look at what's going on right now. Since 2020, U.S. refining capacity has shrunk by more than 1 million barrels per day. Meanwhile, in Europe, shipping disruptions and worker strikes have also eaten into refinery production. But here's the other main reason. Things could get much more dramatic with the European Union's looming pivot away from Russian supply. Here we go. Europe relies more heavily on diesel than any other region in the world. Roughly 500 million barrels a year get delivered by ship, with around half of that typically loaded at Russian ports. The U.S. has also halted imports from Russia, which was a big supplier to the East Coast last winter. How is that sticking it to Putin going on right now? We're freezing and we're pushing the commodities prices higher just to stick it to Putin. And how's sticking it to Putin going on? Here it is. Even the EU is now capitulating. The headline reads, EU set to soften Russian oil price cap plan. Whoops. The Northeast, the most densely populated corner of the U.S., where temperatures are often below freezing during a bitter winter, is also the most reliant on heating oil for keeping homes warm. Diesel and heating oil are the same product in the U.S., just taxed differently. Even in the best case scenario, listen to this, even in the best case scenario, consumers there will be saddled with the highest energy bills in decades this winter. Already, the government has nearly doubled its estimate for the increase, projecting that families who rely on heating oil can expect to pay 45% more than last winter, up from an October estimate of 27%. Wow, peak inflation, you say? And if you happen to listen to this program from New England tonight, prepare to freeze your nuts. You got a little taste of it last weekend, right? And there's more to come. Heating New England homes will be expensive this winter, and expensive is mildly put. Look at this. New England retail heating oil price. This is the first week of November. We're not even in the peak of the winter yet. And look at this. Prices are skyrocketing. You're going to pay an arm and a leg, so you're not going to freeze. So when you look at your utility bill and you're paying an arm and a leg, just rest assured you stuck it to Putin. I know, by the way, you saved the planet too. Anyways, when we look at the New England distillate inventories, look at this. Way below the average trend since 1993. In other words, the Fed has to crash the economy down severely in a deep recession to get the demand to meet supply, because there is no magic wand to all of a sudden restore supply in the market. That's not going to happen. We're talking about years and years of war against the energy industry, threatening the energy industry of extinction. You think they're going to invest in building more refineries? Of course not. Instead, they used the cash, all the profits, and they gave it away back to the investors because the government says don't invest in the energy industry anymore. We're gonna kill you. You see how stupid that is? And how do you profit from all of this? I shared with you some ideas, but the top name that I got in my portfolio right now is the ticker VLO Valero, and I talked about it numerous times in this program. All the way back since October 18th, I said I'm adding Valero and MPC, that's another one, Marathon Petroleum, but Valero is the one. And since then, the name added about 21% worth of gains. Now it has some resistance at around 146.81, which also happens to be the previous top from June of this year. So we're going to face some resistance there, but if the chart makes it, oh boy, we have a rocket ship here. And of course, in my home state of California, we're paying an arm and a leg already, so people in New England, you're getting a taste of what California looks like. Without the sunshine, of course. But our beloved Governor Kim Jong-un Newsom, he slammed Valero's profits. Oh, you greedy bastards. How dare you make some money on profits? What do you think, this is America? But of course, the dear governor forgot that his policies, his idiotic policies, are the reason behind the shortage in refineries. And his idiotic policies are the main reason why we're paying an arm and a leg at the pump every single day in this state. Once again, congratulations. You saved the planet. So when you freeze your nuts this winter, just remember, you're doing it for the planet, brah. I know you're sticking it to Putin too. There you go. And with that, folks, let's move on to the coverage of the stock market, and we begin with the closing of the indices today. And here we go. The Dow Industrial Average closing in the green by 397.82 points, or a gain of 1.18%. The Nasdaq shooting higher by 149.90 points, or a gain of 1.36%. The S&P also in the green by 53.64 points, or a gain of 1.36%. Impressive rally today. Under low volume, of course. Short and trading week, you know the deal. But fortunately for the market, we're not having a recession theme today. We actually got an inflationary theme, with energy coming up number 1, capturing the gold medal, and at number 2 for the silver, materials, and number 3 for the bronze, technology. So we have a little bit of a risk on going on here. Meanwhile, the laggards, consumer defensives, real estate, and industrials. When it comes to the advance to decline ratios, NYSE 76% advancing versus 22% declining. The Nasdaq 56% advancing versus 40% declining. When it comes to commodities, the dollar went down by a little bit, and as a result, we got a rally in energy commodities, crude, both the WTI and Brent, with gains of a little over 1% apiece. And then we have the gasoline RBOB with gains of about 4.4%. Heating oil, on the other hand, down by about 1%. And the party boy, natural gas, closing at around $7 per BTU, with gains of about 2% for the day. When it comes to softs, a down day in lumber worth about 2%. The massacre in coffee continues, with another down day of about 2.5%. Good for the consumer, though, that we're getting cheap coffee. It's not really cheap, but cheaper. And then we have another down day for sugar, another pullback worth about 0.5 percentage point, and similar one for cocoa futures. On the other hand, we have cotton shooting up higher and scoring gains of about 3%, then OJ with gains of a little over 0.5 percentage point. With the dollar down, metals capturing some gains here, although gold is muted. The mature guy in the room doesn't trust the pullback in the dollar. Pay attention to that. But silver up, platinum up, copper up, palladium up, no problems here. When it comes to meats futures, live and feeder cattle futures, down, be it modestly. On the other hand, the new big tech lean hogs shooting up higher and scoring gains of almost 7.75%. When it comes to grains, mostly on the downside, with soybean oil futures bucking the trend and scoring gains of about 1% for the day. On to the big casino, the options market. What's going on here? Tesla remains the hottest table by far, at around 2.5 million contracts traded today. About 53.5% of those were calls. Amazon at number 2 with around 1.6 million contracts traded today. Look at this, 63% of the volume was puts, not calls. People betting for more downside to come for Amazon. And at number 3, Apple with around 960,000 contracts traded today. Once again, about 54% of the volume was for puts, not calls. On to the unusual activities that took place in the options market today. And we start with the ticker XLE. This is the energy ETF We continue to see more and more bets against energy. And of course, they're betting for the market to shift into the recession theme, in which consumer defensives and healthcare lead the pack, while energy leads to the downside. Wishful thinking for now, perhaps, based on the performance of energy stocks today, but in any case, somebody bought these 77 puts for the expiration date, December 30, with expectations that the XLE could move down and lose more than 17.5% of its value by then. They paid around 45 cents apiece to enter this trade, all in all spending around $1.2 million. And then what about the ticker SPY for the S&P 500? Now that the bull flag, if you're looking at the charts, is playing out, traders want to ride on the momentum and score gains here. And somebody bought the 424 calls for the expiration date, December 23rd. With expectations that the name could score gains of more than 6% by then, they paid around $1.15 apiece to enter this trade, all in all spending around $1 million. And then what about the Qs? QQQ, the Nasdaq. A similar trade here. Somebody sees more upside for the Qs. The bull flag is playing out, and they bought the 308 calls for the expiration date, December 30, with expectations that the Qs could score gains of more than 8% by then, and they paid around $1.90 apiece to enter this trade, all in all spending around $1.6 million. And then what about the ticker COIN, Coinbase? And by the way, Mama Cathie Wood, she's buying the dip in Coinbase. She's catching a falling knife over and over and over again. Typical of Mama Cathie. But somebody's bidding against Mama Cathie Wood, and they bought the 39 puts for the expiration date, December 2nd, with expectations that Coinbase could move down and lose more than 10% of its value by then. They paid around $1.60 apiece to enter this trade, all in all spending around $1 million. And lastly, at the bottom of the table, what about the ticker EWY for the South Korean ETF? Any South Korean viewers tonight? Because what I know is if you think that the mania in the US market is insane, wait till you hear about the mania in the South Korean market back in 2020 and 2021. And by the way, South Korean traders were also responsible for the mania in this market here. They stampeded on buying Apple and Tesla and all these stocks, and now they're holding the bag. No wonder why the South Korean economy is crashing. But perhaps enough pain has passed through the South Korean market at least, and somebody sees a rebound coming here, and they bought the 61 calls for the expiration date, January 20, with expectations that the EWY could score gains of more than 7.5% by then. They paid around 80 cents apiece to enter this trade, all in all spending around $400,000. On to the heat map. What's going on here? Nothing to see. A sea of green, a shortened trading week, low volume, you know the story. But leading the pack this time around, the inflation theme of energy and materials. But since the dollar is down, we also see chips participating in the rally. Not a big rally in software or the big caps, but chips are doing pretty good because when the dollar goes down, we see chips rallying higher. When it comes to the defensives, the recession type kind of stocks, they did pretty good, even though lagging. You see the big pharma names, you see the consumer defensive names, mostly in the green, but lagging oil, lagging materials, and lagging chips. And of course, we continue to follow the brutal layoffs at Meta, courtesy of Mark Zuckerberg. And now the employees of Meta say that the metaverse will be our slow death. It is absolutely insane what's going on in Meta, and the engineers know that this is a slow death descending into hell. But how do you knock some sense into Lizard Man? Because the egotistic maniac will fire your ass if you even suggest that the metaverse is a stupid idea. And then we continue to monitor the meltdown in Tesla stock. And so far this year, Tesla lost almost $700 billion, or the equivalent of 3 Disneys and 4 Nikes, or 6 Starbucks. To begin with, the stock shouldn't even be trading as 3 Disneys or 4 Nikes or 6 Starbucks. Did it make sense back then? Does it make sense right now? But the pain is happening because the allure and the brand of Elon Musk, that's melting away now. And look, I support Elon in his freedom of speech endeavor on Twitter, but that will come at a cost. And the cost will be the crash of Tesla stock. On to the heat map for the ETFs. Again, a sea of green across the board. And leading the pack, the inflation theme of energy XOP, XLE, OIH shooting higher, along with metals, GDX, gold miners, XLB, XME, all shooting up higher. We got some decent earnings from retail in the morning, so XRT shot up higher. But the laggards, if you can call them that, are the recession themes that we talked about last night. The XLP, consumer defensives, utilities, IYR, real estate, the XLV, healthcare, So a little bit of a risk on today, but this is only happening because we have a shortened trading week. When we come back next week, we face reality. But until then, we're moving on to charts, and we begin with SPY, the S&P 500 30 minutes chart. Yesterday, we talked about a cup and handle formation, which took us all the way above 398. And the chart closed at the highs of the day. This is bullish, not bearish. The problem is the RSI is getting a little overextended here, to say the least. In other words, yes, the tailwinds for the rally to continue, the low volume, the shortened trading week, yada yada, that's still intact. But that doesn't mean that we're not going to get a pullback based on the technicals and the overbought readings. When it comes to the daily chart for the continuous contract for the SPY, the volume is moving down big, the RSI is firming up, the MACD indicator is firming up, and we see the bull flag playing out. And if this continues, of course, the target for the market will be the round number in the SPX of 4,000. But I like to be a little more conservative and use the futures contract. And in this chart, we see 4,100 as the next resistance. So it could shoot up higher above 4,000. And of course, if that happens, you're going to start hearing talk about the Santa rally, and the worst is behind, the bottom is here, and then what do you know, Santa delivers the bags. On to the Qs, 30 minutes chart, what's going on here? Yes, it is making lower lows and lower highs, but the low volume, the magic of low volume in a shortened trading week, the gravity becomes to the upside, not to the downside. And now we see the chart trading above 284.26, and it is eyeing 290 as the next resistance. But look at the RSI, it is getting a little oversold here, so the chart is becoming primed for a pullback. Perhaps a lot of folks bought calls yesterday and they enjoyed the rally today. Now that things are getting overbought, they dump tomorrow. It's not going to be a major dump, but it could be a pullback. And here's the Qs, continuous contract, a daily chart. Look at this. The bull flag is playing out, and now the chart is trading above 11,689, and the next resistance would be 12,207. The volume is down, the RSI is firming up, the MACD is firming up. Nothing to see here. It's a one-way street for the bulls. What about the IWM 30 minutes chart? What's going on here? We talked about a cup and handle formation. This is playing out already. The chart is above 183.25, and now it is eyeing 188. But it's not going to be an easy endeavor to go all the way to 188 because the chart will become overbought and it will need a pullback before that happens. The DXY, the dollar index, a dollar chart, a daily chart. The RSI is still negative. The MACD is still negative. Yes, we have a pullback, but is this the end of the rebound in the US dollar? Well, gold suggests otherwise. When we look at gold, if this is indeed the end of the rebound in the dollar, gold should have shot up higher. It should have moved closer to 1,763, but it didn't do that. But we see the MACD weakening. We see the RSI weakening on the daily chart of gold. In other words, gold is saying, I don't trust the pullback in the dollar. I don't think the dollar is done rebounding here. This is according to gold. When we look at the daily chart for Brent oil, UK oil, in your charting program, a negative divergence in the RSI and the MACD indicator, so the gravity is all the way to 85, not in the number of 98. However, we got some good news yesterday with the Saudis saying, hey, we're not going to increase output. I don't know what the Wall Street Journal is talking about. And today we get a rally in oil despite the bad news from China of more lockdowns. And if this theme continues, you're going to see oil gathering momentum and moving all the way back to 98. But for now, oil bears have the upper hand, not oil bulls. When it comes to the 10-year yield, it couldn't make it above the resistance. It's now pulling down. Pulling down to which destination at this point? 3.5. The RSI remains negative. The MACD remains negative. We're not saying this is it. It should go all the way to 3.5. It could give it another shot tomorrow, but the chart is running out of time. If it can't close the week above this yellow line of resistance, then in all likelihood, the 10-year is going back to 3.5. And look at the TLT, a daily chart. It is moving away from the resistance zone. It consolidated for a little bit, and now it is gathering and finding the energy to move higher. And if that is the case, the 10-year will go all the way down to 3.5. The VIX 4 hours chart, it appears that the destination would be 20, which the bears, me included, are hoping for, because by that time the chart of the VIX will become oversold and the premiums for puts will become really cheap and we can flip them for a profit easily. And this is what I'm waiting for now. When it comes to Apple, here's a 30 minutes chart. It is moving higher, above 150 again, the no entry zone. Apple bulls can fight the gravity to the downside. They can park illegally above 150, but sooner or later they're going to get towed. So if this week is over and the VIX goes all the way to 20 and Apple is still trading above 150, that would be an awesome shorting opportunity. When it comes to Tesla, a mini rebound today off an oversold reading in the hour sign in the 30 minutes chart. And when we zoom in a little more, let's use a 5 minutes chart. Is this a saucer bottoming formation? That could be the case. And Tesla could move higher all the way back to the resistance at around, let's say 175 at this point. And then we'll take it from there. Bitcoin 4 hours chart. What's going on here? We got a pump today, a rebound, but it doesn't change anything at all. The chart remained weak and everybody's now waiting for 15,000. Who's going to buy right now? Who has the confidence to buy right now when we have all of these tulips crashing? Well, at least not me. Now let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? It's an important day and the last day before the Thanksgiving holiday, which the market will be closed on Thursday. But for tomorrow, Wednesday, the 23rd, we have durable goods, we have initial jobless claims, we have the flash PMIs, we also have the consumer sentiment index from the University of Michigan, along with the 5-year inflation expectations, along with new home sales, and most importantly, the FOMC minutes. Let's see where the dot plots are. We know they're becoming more dovish, but what about the big dogs? What about the important voices? And we're talking about Jerome Powell, Brain Dead, and Williams. But with that, folks, we're done here. This is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Take care.
I was told that the man I would be meeting with is very careful, a cautious man. I believe we're alike in that way.
I ain't gonna lie.